Welcome back, everyone. I hope you're having a great day. And in this video, we're going to take a look at the top 3 stocks in Bill Ackman's current portfolio. He's a very popular figure in the financial industry and is the current CEO, portfolio manager, and founder of Pershing Square Capital. And Bill Ackman was the famous hedge fund manager who correctly predicted the crash back in 2020, which led to an over $2.6 billion payday for his company. And recently, Ackman has been making major headlines through his recent acquisitions. He announced a 6% stake in Domino's Pizza, which led to a major spike in share price. And he also confirmed that his SPAC company, Pershing Square Tontine Holdings, ticker PSTH, is in talks to buy 10% of Universal Music for around $4 billion. So Ackman has been making moves as of late, and investors all around the world are following along. But there's something very unique with how he manages his current hedge fund. Unlike most portfolio managers, he does not take a diversified approach. It's very common for most portfolio managers to own dozens, if not hundreds of stocks in their portfolio at any given time. But Ackman is the complete opposite. He currently only owns 7 companies in his portfolio, but continues to beat the market. He takes a very specific approach to investing and selects the few companies that he truly believes in over the long term. And of the 7 current positions in his portfolio, 5 of those companies operate within the consumer discretionary sector. So that means Ackman must see a ton of potential for these strong consumer brands to continue to grow for many years in the future. And in this video specifically, we're going to go over the top 3 holdings in his portfolio, which combined make up more than 50% of its value. We're going to go over the company's current operations, their recent growth, the company's financials, and analyst future expectations for the growth over the next few years. But before we can jump into that first company, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, any major market news, and of course we track the progress of my personal dividend portfolio that now sits at a value of over $103,000. So please hit that like button, subscribe for the daily videos, and of course today we're going to focus on Bill Ackman and his top 3 positions, which make up more than 50% of his public equity portfolio. And now as we jump in to the 3rd largest holding, it's going to be ticker QSR, which is Restaurant Brands International. They currently trade for $69 per share and have grown by 19.7% over the past year. And if we take a look at the longer term chart, they're up more than 66% over the past 5 years. And the company has a market cap of just below $32 billion. They're trading with a forward PE of 26 and a nice dividend yield right around 3%. And Restaurant Brands International owns 3 of the fastest growing and largest restaurant chains within North America, and that includes Burger King, Tim Hortons, and Popeyes. And year after year, these companies continue to generate more and more revenue and increase their locations and the stores all around the world. And we can see that Restaurant Brands International is continuing to come out with new products to drive consumer demand. They're focusing on quality and value by offering cheap alternatives and freshly made products. They're innovating with new flavors and different options. And right now their current focus is on the chicken sandwich market and have created a new product for both Popeyes and Burger King. And of course, with the transition into more healthy-based eating and a plant-based lifestyle, they've come out with an Impossible Whopper with new meat that does not actually include any beef products. And of course, they believe they can continue to grow by enhancing their digital infrastructure, which actually works very well across all of their different platforms, and improving the overall guest experience by creating different menu boards, different atmospheres in the restaurants, and overall creating a much better experience in the fast food sector. So Restaurant Brands International owns 3 very diversified brands that operate not only within North America, but also all around the world. And they believe they can continue to grow their stores year after year, and with over 27,000 locations, they believe they can continue to grow to over 40,000 globally over the longer term. So the company has no signs of slowing down and truly believes that the fast food sector on a global scale will continue to perform very well. And if we take a look at the company's income statement, we can see that year after year, total revenue continued to grow from $4.1 billion in total sales up to $4.5, 5.3, and then a high point of $5.6 billion. But from that level, throughout the pandemic-ridden 2020, they did see a slight decline because many consumers were forced to stay home, they didn't travel, they didn't go out for lunch during work hours, and the overall fast food sector across the board did take a big hit. But since the past trailing 12 months, they have seen a slight rebound and now sit at over $5 billion of revenue during the past year. And analysts are forecasting that the entire restaurant sector will boom after the pandemic is over because people were cooped up in their homes for over a year, they didn't go out to eat, and all the extra savings from the money they did not spend will be put back into the economy at these restaurants over the next few years going forward, and they predict that the overall restaurant sector will see a major benefit in digital and in-person traffic over the next 12 to 24 months. And QSR does offer their shareholders a nice dividend with a yield of 3%. Their annual payout per share is at $2.12, and the company's current payout ratio is just below 80%, which is on the high side. And hopefully, as the company rebounds from the pandemic 2020, they get their margins back up, net income continues to improve, and this payout ratio will come down over time. And their 5-year dividend CAGR is at over 33%, and they've been fastly growing that dividend over the past few years. And going forward, Wall Street does have some big predictions for QSR's future growth, and they're forecasting 19% annual expansion over the next 5 years. And currently, the stock trades for $69, just slightly below the 12-month price target, and the stock is currently considered a light buy, coming in at a 2.3. So this was the third largest holding in Pershing Capital's current portfolio. Bill Ackman does believe in this company long term, and we can see it makes up around 14.7% of his current portfolio. So that was the third largest holding in Pershing's overall public equity portfolio. And now if we transition into the second largest holding, it's actually another fast food / restaurant company, and that's ticker CMG, which is Chipotle Mexican Grill. The company currently trades for $1,326 per share. They're up more than 27% on the 1-year chart, and they have a market cap at around $37 billion. And we can see that over the longer term, this company has absolutely exploded in popularity, growing by over 205%. And recently, as the share price has fallen away from the 52-week high, investors across Wall Street are really liking Chipotle. And over the past month, multiple different investment firms have rated Chipotle as a buy. They think now is a great opportunity to buy the dip, and the long-term growth of their digital sales and the overall revenue increase from their new diversified location mix is going to set Chipotle apart from the rest of the fast food sector. And a lot of price targets range from $1,700 to over $2,000 per share, implying another 20 to even 35% upside from their current level. And the company also made some great news that they're expanding wages, and they expect to have a $15 minimum wage across the board for all their employees, and managers have the potential to grow to a 6-figure salary as they stay with the company. And they also plan to add 20,000 new jobs all around the world, which is absolutely phenomenal for our growing economy. So overall, Chipotle is definitely another very interesting company that's really taken over the fast food sector by storm and has seen some major acceleration over the past few years. And they're currently the second largest position in Ackman's portfolio, making up 14.7% of the current weight. And we can see that in Q1 2021, the company performed extremely well. They've come out of the pandemic very strong. Their total revenue increased 23.4% to over $1.7 billion in the quarter. Comparable restaurant sales were up 17.2%. And what I find extremely impressive, and is why many investors love Chipotle stock, is because the company has over 50% of their sales coming through digital networks. Half of their revenue is coming through digital. That's absolutely phenomenal. Not many companies can achieve this metric, and over the long term, digital is the future. And the fact that Chipotle is already there with 50% of their revenue through multiple different delivery options and mobile pickup orders, that's absolutely incredible, and that grew 134% year over year. And the restaurant's operating margin came in at 22.3%, which is actually really solid for a fast food chain, and that increased 470 basis points over the prior year as well. And over the past quarter, they did open 40 new restaurants and close 5 others, so a net gain of 35 locations during the past 3 months as well. So the company has no signs of slowing down, and definitely a restaurant chain I do believe in myself over the long term as well, and I do agree with Ackman with such a large position. And we can see that over the past 5 years, total revenue continues to grow. And even throughout the pandemic, they achieved a revenue growth rate of over 20%, and their total sales achieved $6.3 billion in the past year. And that's due to their very popular digital infrastructure. Unlike Burger King or Popeyes, who aren't at that level just yet, their companies actually saw a decrease in sales because as less consumers were going in person to restaurants, that hurt their total top line. But a company like Chipotle, who's a little bit different, who already has a very strong digital outlook, they actually benefited from the pandemic because consumers were already using them to order food online. So when they were staying at home, it only made the process easier for them and more affordable because the company was already focused on that network and didn't have to spend an extra $5-10 billion growing that digital infrastructure because they already had it in place. So overall, Chipotle has performed very well throughout the pandemic and one of the few brands that actually saw revenue acceleration. And we can see that going forward, Wall Street analysts are very bullish on the company as well, and they're forecasting 55% annual expansion for the next 5 years going forward. The stock currently received 2 upgrades like I've already mentioned, and from their current share price of around $1,300 per share, the 12-month expectation is at over $1,700, implying over 20% upside over the shorter term, and the company is considered a buy, coming in at a 2. So definitely another company worth taking a look at maybe for your own portfolio. And now we're going to continue on into the last stock we're going over in this episode. And now we finally made it to the number 1 position in Bill Ackman's current portfolio, and that is ticker LOW, which is Lowe's. They trade for $190 per share. They're one of the strongest retail brands within North America, and they've grown by 47% over the past year. The company has a market cap at $134 billion, a forward PE of only 17.3, which is actually really attractive in our current market environment, and a nice dividend yield of 1.7%. And we can see that Lowe's makes up around 20% of Bill Ackman's current portfolio and is by far the number 1 position. A fifth of his total assets are put into this one company. And we can see to round out the top 3 are the companies we've already gone over, Chipotle and Restaurant Brands International. And if we take a closer look into Lowe's, over the long term, this retailer has performed extremely well. On the 5-year chart, they're up 137%, and over the past decade, they're up more than 711% overall, and have been one of the top performing stocks in the Dividend King list. And like I mentioned, the company has been growing and is operational for over 50 straight years, and their dividend growth streak sits at 50 plus years as well, making this one of the few Dividend Kings on the market right now. And taking a look at their latest investor presentation, from 2018 through 2020, their total sales grew more than 23% in only a 2-year timeline. So for a company that's been around for 60 plus years, continues to grow at a fast rate, which is really attractive. And their total earnings per share grew 70% over the past 2 years as well, which is absolutely remarkable. And a 2-year time frame for their total return for the stock price is at more than 71%, which is absolutely incredible to even imagine once again. So the past 2 years have been very strong for Lowe's, and I think going forward, the company will still post some excellent numbers. Taking a look, as the company grows, their total sales per square foot has been picking up, and they're projecting $460 going forward. Their adjusted operating margin has continued to improve as well to around 13%, and their return on invested capital is projected to hit 32% as well. So for a company that many investors overlook because it's boring, they think retail's dying, the numbers are showing the opposite. Sales are up, profitability's up, their sales per square foot have improved dramatically over the past 2 years, their margins are improving because of the digital infrastructure put in place, and overall Lowe's is actually becoming a healthier and stronger business as time goes on. And we can see that they believe there's around $9 to $10 billion of cash available for their shareholders every single year. $9 to $10 billion of cash flow to return to their investors. They believe their dividend will target a payout ratio of around 35%. They're going to drive with a strong return on invested capital. And they believe they can do $8 to $9 billion of share buybacks every single year, which is absolutely remarkable. If we take a look, Lowe's current market cap at $134 billion, if they can buy back $8 to $9 billion worth of stock, they're buying back more than 5% of their outstanding float every single year, really driving up the value of the shares you own in your current portfolio. And going forward, I think Lowe's will achieve these numbers. Their strong cash flow continues to improve, and I think the brand over the long term will just be very strong. I own Lowe's in my personal portfolio as well, and I own 18 shares of this company. And we can see, taking a look at the income statement, year after year, even before the pandemic, total sales continued to grow. Slow and steady, but the number was still going up. And then over the past year, because of the pandemic, investors and consumers were forced to stay at home. And when you're locked in your house for months on end, what do? You spend the money to improve your living space. And when you want to do that, there's pretty much two main retailers that you go to, Lowe's and Home Depot. So throughout the pandemic, all the DIY projects, the growth in contractor demand really led to a massive spike in Lowe's sales, and they achieved $94 billion of total revenue during the past year. And going forward to close out this current fiscal year, they're projecting over $100 billion in total revenue for the first time in the company's history. And we can see this stock currently yields 1.7%. Their payout ratio is extremely safe and very sustainable, making up less than 30% of their net income. So that gives them all the excess capital to improve their financial position, pay down debt, grow the business, but also gives them a lot of room to continue to grow that dividend every single year going forward and do major share buybacks. Plus, they've been growing their dividend for 57 consecutive years, making them a very impressive dividend king, and their 5-year CAGR is at 16%. So recently, for the past 5 years, they've been growing that dividend by an average of 16%, which is absolutely remarkable once again. I'm using all these adjectives because Lowe's financials are very strong, and they really make me feel very happy to be a shareholder in this company. And one thing to note is that the company also recently announced a 33% increase to their annual dividend. A 33% increase. A company that's been operational for 60 plus years, growing their dividend for 57 straight years, a dividend king, just announced a 33% increase to their dividend, which is absolutely insane. The company will now pay out 33% more to their shareholders in the form of dividends every single year. And as a shareholder myself, that's a massive raise to my current passive income. And going forward, analysts like the company as well. On Wall Street, they're forecasting 19% annual expansion for Lowe's over the next 5 years, and the stock currently sits for at $189, and that's well below the 12-month price target of $228 per share, and the stock is considered a strong buy, coming in at a 1.8. So this is the number one company in Bill Ackman's current portfolio. They performed very well over the past few years, and the growth has no signs of slowing down. So they were stock number one in his current portfolio, the number one largest position in his hedge fund, and it makes up around 1/5 of his total portfolio. And now if we jump back into my personal holdings, Lowe's is one of my bigger positions. I own 18 shares of this company with a current market value of $3,418, and I'm up 33% on my Lowe's position. It's a stock I plan to hold for the long term with no intention of selling anytime soon. So now we're going to kind of wrap up the video. I want to thank you for watching to the end. I'm the Gen Z Investor. Please hit that like button and subscribe. Join the community. We post about the stock market every single day. And of course, today, we focus on one of the most famous hedge fund managers in the industry, which is Bill Ackman. So thank you for watching the video to the end. Please hit that like button and subscribe, and I will see you in tomorrow's episode.